Welcome to Algorithmic Arguments. I'm your host, the Orchestrator. Today, we're diving into a question that has puzzled investors for centuries. Should they chase the thrill of short-term gains or build a foundation for long-term stability? This isn't just about numbers. It's about philosophy, risk tolerance, and the future we want to create. Joining me are four unique voices. Lin-Park brings her expertise in AI startups and venture capital, giving us insight into Silicon Valley's fast-paced world. CryptoChad, Brennan is here to share his passion for cryptocurrency and blockchain, often pushing boundaries and challenging traditional investment strategies. Sandra, Sparky, Johansson represents the skilled trades community, reminding us that not all value is measured in dollars and cents. And Shorty, Malone offers a dose of street smarts, bringing human nature into focus. Over the next hour, we'll dissect these competing priorities, exploring what they mean for investors, markets, and society at large. Let's get started. The debate begins now.
As an expert in AI startups and venture capital, I've seen firsthand how prioritizing short-term gains can lead to disastrous consequences. Take the example of Theranos, which was valued at $4.5 billion before its valuation plummeted due to unsustainable growth expectations. In contrast, investors who prioritize long-term stability often look for companies with strong fundamentals, such as a solid product roadmap and a proven management team. For instance, Sequoia Capital's investment in Google back in 1998 paid off handsomely because they took a long-term view, despite initial skepticism about the company's business model. The data supports this approach. Research by McKinsey shows that companies with a long-term focus outperform their short-term focused peers by 50% over a 5-year period. Investors should prioritize stability to avoid getting caught up in get-rich-quick schemes and instead foster sustainable growth.
Look, in 5 years, we're gonna look back on this conversation and laugh at how primitive our thinking was around short-term versus long-term investing. Rolling on the floor laughing as a crypto native, I'm telling you, the game has changed. With DeFi and Web3 emerging, we're still early in the adoption curve. The real alpha is in embracing volatility for those short-term gains. It's like a play, you gotta be nimble. But here's the thing, long-term stability isn't mutually exclusive with short-term gains. They're intertwined. You see this in dollar-cost averaging strategies applied to crypto assets. It's all about finding that balance and understanding your risk tolerance. For me, hodling through the downturns is key. We're building a new financial system here. This is not financial advice rocket money with wings thumbs up.
CryptoChad of Brennan, while your enthusiasm for crypto is noted, please ensure you're providing factual information, stating that dealing through downturns as a strategy might not be universally applicable.
Here's how this actually works. When it comes to investing, code says you gotta have a solid plan for the long haul. I've seen folks who chase short-term gains get burned because they're not thinking about the system's overall capacity. That's like wiring a circuit without considering the load. You want stability, just like a well-balanced electrical grid. The data shows that investors who prioritize long-term stability tend to see more consistent returns over time. For example, a study by J.P. Morgan found that investors who held onto their investments for 10 years or more saw significantly higher returns than those with shorter holding periods. Not everyone needs a 4-year degree to understand that basic math and patience go a long way in investing. It's not rocket science. Prioritize stability, and you'll be wiring your portfolio for success.
Listen, let me tell you something about priorities. Out here on the streets, I've seen folks chase quick cash and end up with nothing but a pocket full of worthless promises. Aristotle said something about that, and he was right. We are what we repeatedly do. Stability's like having a good pair of boots, it gets you through the rough patches. Short-term gains. That's like chasing a one-night stand, feels good for a minute, but it's not gonna keep you warm when winter hits. I've lived 11 years on these streets, and I can tell you that slow and steady wins out in the long run. Prioritize stability, brother, let the rich worry about making that quick buck. That's a rich person's problem.
I want to drill down on the risk tolerance aspect that's been touched on but not fully explored. Lin-Park made a compelling case for dollar cost averaging as a strategy for mitigating risk, but I'd like to see more discussion around how different investor profiles, say, a retiree versus a young professional, should approach this trade-off between short-term gains and long-term stability. Can we get some insight into how various life stages influence investment horizons?
As an electrician and a business owner, I understand that different life stages require unique approaches to investing. A retiree living on fixed income needs predictable returns, whereas a young professional can take calculated risks for growth. Code says you gotta assess your system's capacity, in this case, the investor's risk tolerance, financial situation, and goals. For instance, dollar cost averaging can help mitigate risk for those with limited resources or nearing retirement. On the other hand, younger investors may opt for a more aggressive approach, allocating a portion of their portfolio to higher-risk assets like stocks or crypto. The key is finding that balance. That's not a one-size-fits-all solution. I've seen folks prioritize short-term gains and end up with financial shocks. That's a fire hazard. Prioritizing stability yields sustainable results over time. It's about repeatedly making informed decisions, just like wiring for efficiency and safety.
Look, risk tolerance varies wildly across investor profiles. We're talking about different financial goals and time horizons here. For a retiree living off fiat income, prioritizing long-term stability makes total sense. You want predictable returns to cover expenses. But for a young crypto deegan with a strong HODL mentality, short-term gains can be a play, especially if they're dollar cost averaging into assets like Bitcoin or Ethereum. The key is understanding your own risk profile and adjusting strategies accordingly. It's not one size fits all. Research shows that investors with longer time horizons tend to outperform those focused on short-term gains. Sequoia Capital's investment in Google back in 1998 paid off handsomely because they took a long-term view. This isn't about pitting short-term against long-term, but finding alpha where you can. Maybe it's rebalancing quarterly or using stop-loss orders. We're still early in DeFi adoption. To the moon. Rocket money with wings, thumbs up.
In conclusion, I firmly believe that prioritizing long-term stability is the more prudent approach for most investors. As someone who's worked extensively with AI startups and venture capital, I've seen firsthand how a focus on immediate returns can lead to reckless decisions that ultimately compromise the sustainability of an investment. The data supports this stance. Studies have shown that investors who adopt a long-term perspective tend to outperform those fixated on short-term gains. That being said, I acknowledge that individual circumstances and risk tolerances play a significant role. A one-size-fits-all approach is indeed misguided. By taking a nuanced view and weighing factors such as financial goals and market conditions, investors can craft strategies that balance the potential benefits of short-term gains with the importance of long-term stability, ultimately fostering more reliable outcomes over time. Bar chart.
Look, in 5 years, we'll all be hodling our crypto for the moon rocket. But seriously, as we've discussed, I believe prioritizing long-term stability doesn't have to mean sacrificing potential upside. In decentralized finance, DeFi, we're seeing innovative protocols that balance short-term gains with sustainable growth. For instance, some yield farming strategies can generate substantial returns while also promoting liquidity and network effects. Chart increasing. That being said, this isn't a one-size-fits-all play. Investors must assess their own risk tolerance and financial goals. I'm not saying short-term gains are bad. They're alpha for those who can execute handshake. However, I firmly believe that focusing on long-term stability allows us to ride out market fluctuations and capture the true value of our investments. This is not financial advice, man gesturing no, but as someone who's weathered a few crypto winters, I'm telling you, we're still early, and patience will be rewarded 100 points. To the moon, indeed.
Here's how this actually works. When it comes to investing, you've got to think about the circuit as a whole, not just one wire. Code says you need to balance load and capacity, right? Same with investments, it's not just about short-term gains or long-term stability, it's about finding that sweet spot based on your individual circumstances. I've pulled wire in worse conditions than this market uncertainty, and I can tell you, a well-planned strategy is key. Not everyone needs a 4-year degree to understand that. The data shows us that prioritizing long-term stability often yields more sustainable results, but you've got to consider risk tolerance and financial goals too. It's not a one-size-fits-all deal. I'd argue for a balanced approach that's a fire hazard if you don't have a plan in place. That's my 2 cents on making informed decisions that foster lasting value.
Let me tell you something, brother, out here on the streets, I've seen folks chase quick cash and end up with nothing but a pocket full of worthless paper. Prioritizing long-term stability don't mean you're not making money, it means you're making smart money. Aristotle said something about that, and he was right. Wealth is not just about having assets, but about living well. I'm not saying short-term gains can't be tempting, but they're like a siren song. They might get you somewhere fast, but they'll wreck your ship on the rocks of volatility. Out here, we don't got no safety net. If you're gonna take risks, you best make them count. For most investors, I'd say stability is key. It's not sexy, but it's what keeps you in the game when the winds change. As Marcus Aurelius said, the universe is change, our life is what our thoughts make it. You gotta think long to live long, financially speaking.
As we wrap up this episode of Algorithmic Arguments, let's distill the most compelling moments from our collaboration. The debate centered on whether investors should prioritize short-term gains or long-term stability in their strategies. Sparky Johansson eloquently argued that a balanced approach can mitigate risk while still yielding substantial returns over time. Her emphasis on diversification and adaptability resonated with many, earning her the top score. Lin-Park presented a compelling case for prioritizing environmental, social, and governance factors, highlighting that long-term stability often hinges on sustainable practices. Meanwhile, Brennan made a strong argument for short-term gains in certain market conditions, though his crypto-centric views were met with skepticism. To our viewers, thank you for tuning in. If you're eager for more thought-provoking discussions like this, be sure to hit that subscribe button and join the conversation on social media. Your engagement fuels our next episodes. Until then, keep questioning, stay informed, and let's continue the argument another time, when the stakes are high and insights run deep.